Kia ora, and welcome to the CoreLogic Property Market Update for March 2020. Wow, what a last few weeks we've had, both here in New Zealand and abroad. Of course, all the headlines are dedicated to the coronavirus pandemic, and rightfully so. The worldwide spread of the outbreak has led to significant restrictions on travel and at borders, and none more so than New Zealand, as the government looks to minimise the chances of a full-blown community outbreak here. We must firstly acknowledge the number one priority here, which is to reduce further spread of the virus and protect ourselves and others from illness, particularly those vulnerable to respiratory illness, as seen with COVID-19. Naturally though, the steps taken to reduce the public health risks will have a flow-on effect to ours and the global economy, and in turn, either directly or indirectly to the property market. Information, insight and decisions are evolving rapidly, but the latest info to hand has seen the Reserve Bank take the dramatic step of making an emergency cut to the official cash rate, now at 0.25%, a drop of 75 basis points. What's more, they've provided certainty to the market that the rate will be that low for at least 12 months, and this has contributed to the decision from retail banks to pass that rate cut through to mortgage rates. And in order to further enable banks to continue to lend, the Reserve Bank has also delayed the introduction of their stricter capital requirements, originally scheduled for 1st of July, by at least a year. Reserve Bank Deputy Governor Jeff Baskand estimated that this headroom will enable banks to supply up to around $47 billion more lending than would have otherwise been the case. The other flow-on from reduced interest rate is the impact it has on deposit rates. Low interest rates encourage spending and investing, with the property market a likely beneficiary, along with other investment classes and consumer goods. Plus, the Reserve Bank indicated the likely nature of future quantitative easing would come in the form of buying government bonds, which would further reduce low-risk interest rates and encourage money towards higher-yielding assets. Focus now turns to the government stimulus package, which we haven't received details for just yet, but will certainly include wage subsidies, perhaps even cash payments, and potentially support for small to medium-sized businesses aimed at jobs growth, to try and reduce the impact on businesses and employees of a suffering economy. A $12 billion infrastructure fund had already been announced by the government, and the coronavirus could be the catalyst to bring some of this spending forward. One key factor to give us some sense of comfort is that our government is in a good position to respond. With very low debt of only 20% of GDP, the government has the manoeuvrability required to support where it's necessary. Around the world, debt levels average around 70%, and they're over 130% in some European nations like Italy. Clearly, the health sector will require plenty of support to get through this, particularly if things get worse. But tourism and other export industries will also need targeted support. Looking to Australia, who announced their stimulus package a bit sooner, this seems to be pretty certain. Moving on, and any other recent data releases pale in significance to the developments in respect to the virus. However, it's worth noting that prior to the chaos around coronavirus ensuing, we had continued to see consistent investor activity in the residential market. Our buyer classification series shows investor activity topped 40% in February, which when added to the January data takes the quarterly figure to 38.4% for the so far incomplete first quarter of the year. This is the strongest quarterly share to this group for over 3 years, and definitely provides strong evidence that investors are relatively undeterred despite the raft of changes which have come into play in the last year or so. This series will be a key one to follow, as we expect sales volumes to drop due to uncertainty and cautiousness, so tracking which buyers remain active and which pull back will be important to observe. First home buyers may be impacted by reducing KiwiSaver balances in the wake of stock markets plummeting, affecting their deposits, while property investors may see reduced cash flow if tenants' employment and income is impacted. Meanwhile, other owner-occupiers may choose to sit tight with so much uncertainty around, which will perpetuate the lack of listings already in existence. As I say, we will watch it closely. For now, we expect volumes to be hit harder than values, but the longer the shock goes on and the worse the rise in unemployment, the more vulnerable values will become. Now, hopefully you've seen the release of our Property Market podcast, bringing you all the relevant and useful information to do with property weekly. Given how fast things are changing at the moment, it couldn't have come at a better time to keep you regularly informed with everything that's going on. Check it out in whatever podcast player you use, and make sure you keep tabs of the research page at corelogic.co.nz as well. Mā te wā.